Thank you for standing by, and welcome to the Limeade fourth quarter investor conference call. All participants are in a listen-only mode. There'll be a presentation followed by a question and answer session. If you wish to ask a question, you'll need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Henry Albrecht, CEO. Please go ahead.
Thank you, operator, and thank you all for joining the call today. My name is Henry Albrecht, CEO of Limeade, and I'm here to present an overview of our business activities and cash flow results for the quarter ended 31 December 2020. Joining me today is Limeade CFO Toby Davis. I would like to start the call by commenting on our closing FY20 contracted annual recurring revenue, or CAR. As we informed investors throughout the year, the company experienced a slowdown in sales due to new enterprise customers as a result of COVID-19, the global recession, massive unemployment, economic uncertainty, and frozen enterprise HR and benefits departments' budgets. This has impacted FY20 CAR, which closed at $55 million, down 4% on FY19. Limeade does expect to finalize a high percentage of current contracts under negotiation. However, some have pushed into 2021, impacting our final CAR for 2020. Despite the challenging year, our 5-year CAGR for CAR is still 15%. Indeed, this is the first year of negative CAR growth for the last decade at Limeade. Limeade has proactively navigated through the pandemic by providing science-based COVID-19 information and updates to our customers and employees worldwide, exemplified by our Limeade Care and Crisis efforts. We exhibited sound financial discipline by applying the handbrake to some initiatives in the face of uncertainty, which has preserved cash while also structuring the business appropriately for a stronger 2021. We found more efficient ways of operating, especially in the way we do sales and marketing in a remote work world. And we've invested in our own award-winning culture and in the innovative and industry-leading Limeade One platform for employee well-being, engagement, inclusion, and communications, all essential to the future of work. I will also comment on our customer terminations or non-renewals or churn for the year. Although our overall churn increased during FY20, which decreased our net revenue retention, or NRR, below 90%, our direct enterprise business churn was within budget expectations for the quarter and for FY20 overall, and lower than FY19 despite COVID-19. In our view, the pandemic has highlighted the resilience of our business model and the critical partnerships Limeade has with its enterprise customers and their employees. None of our top 5 customers, which on average has accounted for approximately 25% of our CAR, were lost during FY20. Our employees remain steadfastly committed to innovating, nurturing, and growing these relationships. The vast majority of contracts lost during FY20 were purely budget related. Consistent with our prior statutory financial reporting periods, the company will provide more detailed information on CAR, customers, churn, and general operations and outlook, including our FY21 financial guidance, at our FY20 results on Friday, 26 February 2021. The company's total sales and marketing pipeline at Q4 2020 was $226 million, up 3% on the total pipeline at Q3 2020, which stood at $219 million. Excluding the University of Texas System contract announced in late December, our late-stage finalist and verbal pipeline was up 6% to $12.8 million versus the prior corresponding period. Select contracts did not close as expected in Q4 2020 and are now anticipated to close in 2021, subject to the normalization of business activity we expect in conjunction with COVID-19 mass vaccination programs. I'm pleased to report that the signs thus far in 2021 from Limeade and customer pipeline execution look promising. There can be a timing delay between contract signing as measured by CAR and revenue recognition as the services commence for the employee populations we serve, as a reminder. I will now turn the call over to Toby, who will walk you through the operational and financial highlights for the quarter. Thanks. Introducing Limeade CFO Toby Davis.
Thank you, Henry. I will provide a brief summary of our quarterly cash flow information and our fiscal 20 financial guidance before providing investors a brief update on CAR and contracts. As Henry reminded investors, our audited financial results and detailed operating and financial metrics will be provided in further detail at our fiscal year 20 results on Friday, 26 February 2021. During the quarter, the company recorded cash receipts from customers of $14.3 million. Net cash receipts from customers after adjusting for payments made in relation to the sale of third-party products and services was $11.9 million. This was down 40% versus Q3 2020. However, that reflects the seasonality of annual cash payments collected up front from enterprise customers. Overall, fiscal 20 net cash receipts of $60 million were up 10% versus the prior corresponding period. In Q4 2020, third-party payments of $2.3 million were down 51% versus Q3 due to a reduction in demand from biometric screenings and well-being incentives resulting from COVID-19 related due to constraints on travel, in-person events, and corporate budgets. Cash payments during the quarter were related to the following costs: staff costs of $9.1 million, administrative and corporate costs of $2.8 million, operating of $600,000, marketing of $600,000, and research and development of $300,000. Staff costs overall declined 1.5% over Q3, while headcount continued to track at a lower rate than prospectus forecast due to the reduction in hiring associated with general business uncertainty during the COVID-19 pandemic. We provided our use of funds table in Appendix 1 of today's announcement per ASX requirements to allow investors to track our progress since the IPO. To date, we continue to track under our expenditure plan from the funds raised in the IPO, with cumulatively $12.7 million invested to date. Net operating cash outflow for the quarter was $1.5 million, significantly below Q3 cash inflow of $3.7 million, again reflecting the seasonality of cash receipts and the timing collection of a material annual subscription payment received from a large enterprise customer in Q3. On a full year basis, strong operating cash inflows of $3.7 million were recorded, highlighting the strength of the company's annual subscription model and long-term contracts with large enterprise customers. Our cash balance at 31 December 2020 was $31.5 million, with the company remaining debt-free and well-positioned to capitalize on both organic and inorganic growth opportunities during 2021. In addition, we have $15 million in undrawn debt available to the company. With respect to our fiscal 20 guidance, on a preliminary basis, Limeade anticipates an improvement in each of the three financial metrics provided in the fiscal year 20 guidance, with the audited results available in late February as mentioned. Revenue of $56.1 million, EBITDA loss of $0 to $2 million, and a net loss after tax of $1.5 to $3.5 million. Turning now to contracts, churn, and CAR. In Q4 2020, Limeade signed 7 new enterprise contracts, all of which were in North America, well-being deals, with one significant enterprise contract within the government sector going to the University of Texas system. UTS is a 3-year, $2.3 million annual subscription contract that was signed in late December and announced to the ASX. The University of Texas system is now a Limeade top 5 enterprise customer. The company recorded fiscal year 20 CAR of $55 million, down 4% on fiscal year 19. Over the last 5 years, including 2020, the compound annual growth rate in CAR has been 15%, highlighting the strong growth attributes of the company's core well-being business. In fiscal year 20, Limeade signed a total of 18 new enterprise contracts versus 30 in fiscal 19, reflecting COVID-19 effects on enterprise HR and benefit budgets in North America and Europe. During the quarter, the company experienced a higher overall level of churn, with total annualized net revenue retention, or NRR, declining from 93% to 87% as at 31 December versus Q3 2020. However, our direct enterprise business ended fiscal year 20 with a net revenue retention of 90%. Investors should note that the Limeade direct channel is the core driver of the business and represents 90% of overall fiscal 20 CAR. Despite the impact of COVID-19, direct churn was within our budget expectations for the quarter and for fiscal year 20 overall. We are particularly proud of this achievement in light of the difficult operating environment. Additionally, the overall level of direct churn was lower than the direct churn recorded in fiscal year 19. As previously disclosed to the market, we attribute churn to the economic pressures of the COVID-19 pandemic and related layoffs, furloughs, and HR-related budget cuts. The principal driver of the overall decline in total NRR was a significant increase in the indirect or partner churn of the business. The company has a key reseller partner focused on small and medium business that experienced significant churn. I would now like to turn the call back to Henry for additional comments and closing remarks.
Thanks, Toby. To summarize our quarter and in totality our 2020 financial year, I would say that Limeade has shown incredible resilience in times of global uncertainty, with our direct enterprise customers continuing to commit to the company, our innovative technology platform, and the people and the culture that created it. We've demonstrated robust financial discipline in our first full year as an ASX-listed company, delivering strong, positive operating cash flows, a cash position largely unchanged from FY19, 2 material upgrades to our FY20 financial guidance, and on a preliminary basis, we expect additional improvement once our audited FY20 financial results are released to the market. Our 2021 focus to grow CAR will be by our direct enterprise channel, and we will continue to evaluate market opportunities, including M&A, that could make a meaningful additional contribution to CAR over the longer term. The signs thus far in 2021 are promising, with a strong pipeline and numerous conversion opportunities. Having weathered the challenges of 2020, I look forward to what 2021 holds for the company. I will now hand it over to the operator for the question and answer session. Thank you.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Seth Hoskin of Canaccord Genuity. Please go ahead.
Hey Toby, hey Henry, how's it going guys? Thanks for taking the question. Just wanted to start firstly on the CAR result and in particular churn. Appreciate the colour you guys gave there. I was just wondering, within the churn you highlighted that there was no top 5 customers, but was there any sort of significant customers within the 10 to 15 or 10 to top 20 range? And was there any industries that were overweight in particular? I know that there's obviously a focus on that. We had some large airline customers and some in hospitality and retail, and wondering if there was also any downgrading in CAR, lower employee numbers on the re-sign.
To answer the last part first, I don't think we saw a lot of downgrading. As we mentioned in prior calls, and thanks Seth for the question, we estimate about 30 to 35% of our business was exposed in more vulnerable industries, less defensive industries. And so in some of those were pressured a little bit harder than the other industries due to COVID-19. My expectation is we'll share a little bit more detail on where in the lineup of our 100-plus direct customers that churn came specifically, but I don't think we have any details to share at this time. Toby?
Yeah, there wasn't any specific concentration in any industry that was vulnerable, other than just the general vulnerability of some sectors that it was kind of evenly spread.
Cool. Thanks, guys. And just looking at that NRR number into FY21, I'm assuming you guys will give more detail at the full year result in February, but
correct.
Can you talk to
that'll come out in the forecast in fiscal at the end of February.
Okay, cool. But just in terms of the 90% NRR in direct, is that probably a pretty reasonable assumption at this point, given churn should normalise a little bit, and then hopefully the upsell starts to come back through? I know that part of the pipeline had slowed a little bit as well in the third quarter.
It might be a general and vague response, but we certainly hope and expect 2021 to be an improved year in almost every way over 2020. Obviously, we can't predict everything about how this virus will be put out of its misery, but our general expectation is to return to growth in 2021 in many different ways.
Cool. Thanks, guys. Just a couple more from me, and just firstly on the head count, you obviously delayed a bit of the investment in S&M throughout the last couple of quarters. And moving into FY21, is this kind of just a wait and see to see if you put the investment back in when you can see the growth coming, or is it sort of how you're thinking about that headcount? Is this a different approach to things generally? You've highlighted some operational changes in terms of travel and how you're working with customer success. So just wanting to understand how headcount looks in FY21.
Yeah, I would just, we can get into all those details in February, but I would just say right now we feel pretty balanced in our approach. We've got the staff to execute against that pipeline that we disclosed, the over 223 million. So I think we feel pretty good where we're starting the year, and we'll look at the year as things progress, and if we see opportunities to further down invest in growth, we'll do so. But I think we see a pretty stable year for next year.
Yeah, the only thing I would add to what Toby said is we feel like some of the savings that we saw due to financial discipline in 2020 were temporary. We do expect a return to travel at some point soon here in the States, which has been extraordinarily challenged by COVID. But we also believe that some of the savings that we achieved will be permanent in nature due to increases in digital marketing, webinars, and some of the other elements that have been successful for us in our marketing engine.
Cool, thanks guys. And just more of a sort of general question about COVID. Obviously it's impacted the enterprise sales cycle and things are getting pushed out with budgets unfreeze, but just thinking sort of over the medium term, how do you guys think about that as a bit of a potential tailwind as you come out? As people are working from home more, they're separated, people need to communicate with their employees and manage that, and how are customers kind of coming to you in the pipeline saying, not right now, but we need to think about this as our employee base spreads out?
I think that's spot on. It's an astute question, and I think that's what's happening. I think the initial onslaught of COVID was a freeze. I've used the word freezing. A lot of budgets were frozen. A lot of U.S. employers, where the bulk of our businesses, had significant layoffs. Unemployment shot up to 14, 15% in the States. And with that unemployment rise, were just a lot of people frozen, or maybe even not even with the bandwidth or the headcount to launch new programs. We're starting to see a thawing of that, and that's very promising for us, because the things that Limeade does, hard to reach employees with communications about emotional health and well-being, physical health and well-being, financial, as well as employee engagement and inclusion. Those are all extremely hot topics, and any HR analyst or researcher is putting employee well-being and staying connected with remote workforces in the future of work as a super essential thing for enterprises to invest in, and some, including Forrester, have given Limeade a nod as one of the leaders in thinking about employees that way.
I think, too, what I'll add is, as we've mentioned, our typical sales cycle is anywhere from 10 to 12 months, and maybe some of that's gotten a little pushed out over 2020. But what I'll also say is, the University of Texas system, that was on a much shorter time frame than our typical sales cycle. So, they prioritized this, and we were able to close that deal with a very short time frame. So, as maybe there's also the opportunity for some prospects through the pipeline to prioritize this, and that's the part that we don't, I think as vaccines come on board in the U.S. and there's a greater adoption of that, maybe there'll be an acceleration of the prioritization of continuing to invest in these programs instead of waiting throughout the year. But again, it's speculative in nature, and we can see opportunities, of course, but also risks.
Perfect. Thanks, guys. Really appreciate the time. I'll jump back in the queue.
Thanks, Seth.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. There are no further questions at this time. I'll now hand back to Mr. Albrecht for closing remarks.
Thank you, operator, and thank you all for joining the call today and for your questions. We look forward to transforming work into a source of positivity, energy, humanity, and purpose with Limeade Employee Experience Software. We will speak with you again Friday, 26 February, 2021. Onward.
That does conclude our conference for today. Thank you for participating. You may now disconnect.